This video explores the essential key performance indicators that guide restaurant strategy. KPI number 1. The average check is a fundamental metric for per-guest revenue. When its growth stalls, operations often implement systematic upselling programs. These programs typically involve training on recommending high-margin items, promoting limited-time offers, and suggesting featured pairings. A modest increase per guest can significantly impact overall profitability. Here is the formula. Average check equals total sales divided by number of guests. After understanding per-guest revenue, the logical next step is to analyze the profitability of the menu itself through the contribution margin. KPI number 2. The contribution margin determines the profitability of individual menu items. It represents the portion of sales that contributes to covering fixed costs. Operations commonly use this to identify and promote star and plow horse items, while re-evaluating puzzle and dog items. A standard pricing method involves multiplying the portion cost by a factor, for instance, by 4 to target a 25% food cost. Here is the formula. Contribution margin equals menu price minus standard portion cost. While contribution margin reveals an item's profitability, next comes RevPASH, measures how effectively the entire physical operation converts its seats into revenue over time. KPI number 3. Revenue per available seat hour measures an operation's efficiency in monetizing its seating capacity over time. A higher RevPASH indicates superior asset utilization. To improve RevPASH include introducing table turn incentives during peak hours, optimizing the menu to increase average revenue during high-demand periods, creating time-based promotional menus to boost revenue in slower periods. Here's the formula. RevPASH equals total revenue divided by available seats multiplied by operating hours. Parallel to maximizing seat revenue is the need to efficiently manage the cost of goods, which is measured by inventory turnover. KPI number 4. Effective inventory control is a cornerstone of sustainable operations. A low inventory turnover rate can be addressed through just-in-time ordering or lean inventory systems. Repurposing slow-moving inventory into daily specials is another common tactic. The industry often targets 4 to 8 turns per month to maintain capital fluidity. Here is the formula. Inventory turnover equals cost of goods sold divided by average inventory. After optimizing inventory flow, the focus shifts to the productivity of the team with sales per labor hour. KPI number 5. Sales per labor hour is a key indicator of staff productivity. Operations seeking to enhance this metric may establish clear career paths, develop recognition programs, or implement skill-based pay structures that reward cross-training. Performance targets generally range from $75 to $150 in sales per labor hour, varying by concept. Here is the formula. Sales per labor hour equals total sales divided by total labor hours. Concurrently, monitoring the staff turnover rate is critical. With an industry average often between 70% and 100% annually, high turnover inflates operational costs, while team stability positively influences the guest experience. To improve retention, operators can focus on implementing a clear career path and skill-based pay program to foster growth and recognition, conducting regular stay interviews to understand employee motivations and address concerns proactively. Formula. Staff turnover equals number of separations divided by average number of employees multiplied by 100. This team productivity directly influences and is influenced by the ultimate measure of guest experience and loyalty. KPI number 6. Average rating measures overall guest satisfaction on public review platforms. Interpretation. Below 4.0, critical, needs immediate action. 4.0 to 4.5, good but vulnerable to competition. Above 4.5, excellent, strong market position. Actions for low scores. Identify top 3 complaint patterns from recent reviews. Train staff to resolve these specific issues immediately. Respond professionally to show commitment to improvement. The Net Promoter Score, NPS, is another method to measure loyalty by asking how likely they are to recommend you. A negative score signals that unhappy customers outnumber loyal fans, harming reputation and growth. To improve, immediately empower staff to resolve complaints and analyze critical feedback to fix root causes like slow service. Here is the formula. NPS equals % of promoters minus % of detractors. This guest satisfaction directly fuels revenue, impacting the core financial health measured by the break-even point. KPI number 7. The break-even point is a strategic compass, identifying the sales volume required to cover all costs. For a profitable operation, it is not a target, but a critical threshold to surpass as early in the period as possible, creating a buffer for profit and growth. Here is the formula. Break-even point equals total fixed costs divided by contribution margin ratio. To accelerate past the break-even point, operators can pursue two primary strategies. First, they can increase the contribution margin ratio by adjusting menu prices or optimizing portion costs. Second, they can implement tactics to drive sales volume earlier in the period and conduct a fixed cost audit to lower the overall financial threshold. For a deeper dive into cost fundamental formulas, explore my previous video. By mastering these interconnected KPIs, operators can transform data into a clear roadmap for sustained profitability. Thank you for watching.